Level 0 isn't about money. It's about a mental shift most people never make. A job pays you for your hours. A holding company pays you for the equity you control. That's the entire difference. At this level, you don't own a single business yet, but you already understand what a holding company actually is. A parent entity that owns shares in one or more operating companies, collects their profits, and shields you from their individual risks. Most first-time buyers get this backwards. They go looking for the perfect business before they understand the structure they're going to hold it in. Fix that order. Before you sign a single letter of intent, you need to know how ownership will flow. Who owns the holding company? Who owns the operating company beneath it? And how cash moves between the two. The other thing that separates level 0 from level 1 is willingness to operate. A holding company isn't a stock portfolio. It's active ownership. You are going to run these businesses or hire someone who does. And that means treating the first acquisition less like an investment and more like a career change. Once that mindset clicks, you're ready to go looking for your first deal. And at this level, you don't need capital to do it. You need something else instead. At level 1, the constraint isn't money, it's credibility. Nobody hands a 25-year-old with no track record a 7-figure loan. So the first deal almost never gets funded with a bank. It gets funded with skills used as equity. Here's what that looks like in practice. You find a small, unglamorous, cash-flowing business, an HVAC company, a laundromat, a local service business, run by an owner who's ready to retire and has no succession plan. Instead of offering cash you don't have, you offer competence. You'll run the business, professionalize it, and pay the owner out of future profits. That's seller financing. The seller becomes your lender, and the business's own cash flow becomes your down payment. The deals at this level are small on purpose, usually under $250,000 in purchase price, because the goal isn't the size of the check. It's proof of concept. You're building a track record, a business you found, negotiated, closed, and improved without outside capital. That track record is the actual asset you're creating at level 1. It's what convinces a bank to say yes at level 2. Two things kill most people at this stage. First, chasing a business that's too complicated for a first-timer to run. Second, overpromising the seller on payment terms the business can't actually support. Keep the first deal boring, keep the terms conservative, and let it prove itself before you look for the next one. With one proven deal behind you, level 2 is where outside capital enters the picture for the first time, usually through an SBA 7A loan. Banks that wouldn't return your calls a year ago will now look at your operating history and start underwriting you, not just the business. This is also where due diligence stops being a formality and starts being the thing that saves you. At this size, you are no longer buying a business on a handshake and a hunch. You're pulling quality of earnings reports, verifying that the seller's discretionary earnings are real and repeatable, and stress testing whether the business can service new debt on top of its existing obligations. The math that matters here is simple but unforgiving. Does the business generate enough free cash flow to cover loan payments, pay you a reasonable salary, and still leave a cushion? If the answer is barely, walk away. Level 2 isn't about buying the biggest business the bank will approve you for. It's about buying the business whose cash flow gives you room to breathe, because the next acquisition is going to ask you to run 2 businesses at once, and you'll need bandwidth, not just numbers on a spreadsheet. Level 3 is where you stop being a business owner and start becoming a holding company operator, because now there are 2 entities under one roof. The temptation is to run them as 2 completely separate businesses with separate bookkeeping, separate bank accounts, and separate everything. Resist it. The entire advantage of a holding structure is shared infrastructure. One bookkeeping system tracking both entities side by side, one payroll provider. One person, you or a bookkeeper you hire, who can look at a single dashboard and see Entity A's cash position next to Entity B's, instead of logging into two different systems to piece it together. This is also the level where referral sources start to matter more than cold outreach. Accountants who do the books for small businesses see succession problems before anyone else does. An owner who's slowing down a business with no next generation to take over. A relationship with 2 or 3 accountants in your target industry can generate better deal flow than any online marketplace. Financially, this is the range where lenders start asking for consolidated financials across your entities, not just the standalone numbers for whichever business you're trying to buy. Get ahead of that. Build the shared reporting system now at 2 entities while it's simple, because by the time you're running 6, retrofitting it under pressure is far more expensive than building it early. By level 4, a single bank relationship stops being enough. Different acquisitions call for different kinds of debt, and understanding which tool fits which deal becomes one of the most valuable skills you can develop. Conventional bank debt still works when the target business has clean, well-documented financials and predictable cash flow. That's your cheapest capital. Asset-based lending, or ABL, comes into play when a business is asset-heavy. Inventory, equipment, receivables, and a lender is willing to lend against those assets rather than purely against cash flow. Earnouts let you bridge a valuation gap with the seller by tying part of the purchase price to the business hitting agreed performance targets after close. And seller notes remain useful even at this size, letting the previous owner stay financially tied to a smooth transition. The mistake to avoid here is matching the wrong debt to the wrong business. Fixed debt service, the same payment every month regardless of performance, is dangerous on a seasonal or lumpy revenue business. What you want instead is repayment that scales with revenue, heavier payments in strong months, lighter payments in slow ones, so the business's cash flow and its debt obligations move together instead of fighting each other. Get that match wrong even once at this level, and a single bad quarter in one entity can put pressure on your entire portfolio. This is the level where risk management stops being optional. With 4, 5, 6 entities under one holding structure, the way you've built the legal and financial architecture around them determines whether one failing business can drag down the rest. The core principle is structural separation. Your holding company sits at the top, owning shares in each operating company below it. Each operating company should carry its own liabilities, its own debt, and its own operational risk, walled off from its siblings. Without that separation, a lawsuit or a bankruptcy in one entity can expose the assets of every other business you own. Cross guarantees are the thing to watch for closely. Lenders often want a personal guarantee or a guarantee from your other entities to backstop a loan on a new acquisition. Every guarantee you sign links that entity's risk back to you and sometimes back to your other companies. Some cross guarantees are unavoidable at this stage, but you should know exactly which entities are exposed to which debts, and you should be renegotiating those guarantees out as each business matures and can stand on its own credit. You do not manage this kind of leverage after it becomes a problem. You manage it in the term sheet before you sign, because by the time a cross guarantee actually gets called, the conversation about restructuring it is already too late. Somewhere around level 6, the math stops working if you're still the one holding every piece together personally. This is where you hire your first real finance leader, a controller or a fractional CFO whose entire job is standardizing how every entity reports, closes its books, and forecasts cash. It's also where you formalize what used to be instinct, the integration playbook. Every acquisition before this, one probably got integrated a little differently, based on whatever made sense at the time. At this level, you write it down. The first 90 days after close look the same for every new business. Same onboarding for the systems, same reporting cadence, same KPI dashboard, same cash management setup. Consistency here isn't bureaucracy. It's what lets you close your books on time across 6 or 7 entities without a fire drill every month. The KPI dashboard itself becomes your early warning system. Revenue, gross margin, cash conversion, and debt service coverage tracked at the entity level and rolled up at the holding company level. So you can see a problem in one business 3 weeks before it would have shown up in a bank statement. At this size, the businesses can run without you in the room every day, but the reporting system has to be good enough that nothing can hide from you either. Level 7 is where the capital funding your growth starts to change character. Bank debt and seller notes got you this far, but the acquisitions ahead are bigger, and so is the capital they require. This is typically when mezzanine debt and minority private equity investment enter the picture. Mezzanine debt sits between senior bank debt and equity, more expensive than a bank loan, but far less dilutive than selling equity outright, and it lets you fund a larger acquisition without giving up ownership. A minority PE investment is a different trade entirely. You give up a slice of ownership, but you gain a partner with deeper pockets, deal experience, and often a network of relationships that can accelerate your next several acquisitions. Either path brings governance into the conversation for the first time. A mezzanine lender wants covenants, financial thresholds you agree to stay above. A PE investor typically wants a board seat and real information rights. Neither is a bad thing, but both mean you're no longer the only voice in the room making decisions. The founders who do well at this level treat that as an upgrade, not a loss of control. Because the standards a good capital partner holds you to are usually the same standards you'll need, in place anyway, before you're ready for the levels ahead. By level 8, you've spent years plowing profits back into acquisitions instead of your own pocket. This is the level where that starts to change. Through a dividend recapitalization, here's the mechanic. Instead of selling any part of the business, you refinance the portfolio with new, often larger institutional debt, replacing older, smaller loans with a single, more efficient debt facility size to the portfolio's now larger cash flow. The difference between the old debt and the new debt doesn't go into more acquisitions. It goes to you as a dividend while you keep full ownership of everything. Done well. A recap is how a founder finally de-risks their personal net worth without giving up the company they built. Done carelessly, it's how a founder over-leverages a healthy portfolio right before a downturn. The discipline that matters here is the same one from level 4, just at a bigger scale. Make sure the new debt's repayment schedule still matches the portfolio's real cash flow, with room to spare, not just room based on last year's best case numbers. A recap is also a signal to the market. Institutional lenders don't offer this kind of financing to a shaky portfolio. Qualifying for one is proof that your holding company has become a real, bankable, cash-generating platform. At level 9, you're no longer just accumulating businesses, you're running a platform, and buyers of platforms think differently than buyers of single businesses. A platform is a holding company built around a specific thesis, a fragmented industry, a shared customer base, a repeatable operating model where each add-on acquisition makes the whole portfolio worth more than the sum of its parts. At this size, every new deal gets evaluated against that thesis first. Does this add-on deepen the moat, add density in a region, or unlock cross-selling across the businesses you already own? Deals that don't fit the thesis get passed on, even if they be profitable as standalone acquisitions. This is also the level where you start building for an exit, whether or not you plan to use it soon. That means audited financials instead of just clean bookkeeping, a management team that can run the platform without the founder in every meeting, and a growth story a larger private equity firm or strategic acquirer can underwrite with confidence. 50 million in enterprise value isn't the finish line. It's the point where the same holding company structure you built at level 0, with nothing but a track record and a willingness to operate, has become a platform serious institutional buyers are competing to acquire. 10 levels, $0 to 50 million. And notice what didn't change along the way. The core structure of a holding company, owning operating companies below it, protecting you from their individual risk, and letting their combined cash flow work for you. What changed was the sophistication, from seller financing on a single small business to a diversified debt stack across a dozen entities to institutional capital and a recap that finally paid you back. If you're at level 0 right now, the only thing separating you from level 1 is finding one small, boring, cash-flowing business and offering the owner something more valuable than cash: your willingness to run it. Subscribe if you want the next video, where we break down exactly how to find and structure that first deal.